So what are you expecting in 2021? Our investment committee has some thoughts that might interest you when it comes to your money. So in the past, I've been too wordy on these market updates. I know, who me, talk too much, big surprise. But I do want to give you some high-level thoughts of the market along with Carson and Miles from my team. So there are some new opportunities in this post-COVID economic recovery. You see countries like Australia that have been COVID-free for a few months, and other economies like China and the US that have seen exploding economies. And then there's really good positive implications of this vaccine rollout, an accommodative Fed, meaning that it's unlikely that they're going to increase rates anytime soon. And we see the opportunity of playing both growth and value managers in what we call a barbell approach within our strategies and our portfolios and models. Volatility has been fairly low and the market returns have been up. And that's mainly because the market is baking in this vaccine rollout being successful. And so obviously we're in the middle of that and still more data to come. And this is a big deal, right? Because it allows people to get back out and travel. I know I miss that. And obvious reasons that's good for the economy. Now, as far as the election goes, it's not ideal that any one party would have all parts of Congress. And we know Democrats have that now. But the big concern is that, is there going to be sweeping overhauls of taxes, healthcare, spending? And BlackRock, who's a big institutional investment firm that we speak with a lot, they think it's highly unlikely that it's anything too far to one side because of senators like, I believe it's Joe Manchin out of West Virginia, are unlikely to vote that way, which means, again, we're likely to see some gridlock even with a Congress with one party on the polarizing items like a huge tax cut and maybe a Green New Deal. Now, will taxes go up? Yes, but likely to be more moderate than what a lot of us have been hearing and I've had clients asking about. And yeah, we're probably going to have some increased regulation. We're likely going to have a stimulus bill coming soon that's going to dump a bunch of money into the economy, into people, which will be great in the short term potentially because the market likes stimulus. But over the long term, 1, 5, 10, even 50 years, it could hurt us as we find ways to pay that back. And I'll say this though, and very important, far more money has been lost by investors preparing and anticipating and fearing a correction than has actually been lost during the correction themselves. And that's something I've seen over my 20 years. And I was literally just talking to my father over breakfast this morning. And remember this, the first rule of compounding interest when it comes to investing is to never interrupt it. Very important.
The Federal Reserve has committed to keeping interest rates extremely low for the foreseeable future, until they feel like inflation is around their target of around 2% or above. So this means there's an increased appetite for stocks, because if interest rates are so low and fixed income's yielding next to nothing, where else are you going to go for your return? Also, we're currently evaluating companies that we feel are undervalued because over the past year, some sectors have taken off and yielded awesome returns in the stock market. But there are certain sectors that we feel are undervalued, like international developed, as well as small cap value, and we're looking to place those and add them into our strategies. And lastly, we're reviewing ESG, which stands for environmental, social, and corporate governance, or in other words, socially responsible investing, as an actual performance driver in our strategies. Because in the past, this was more of a talking point and to appease certain client sensitivity. But now it's becoming a lot more popular theme, especially with millennials, as we as a general public are all becoming more socially aware and responsible.
When it comes to fixed income, we are trying to avoid buying junk bonds with low credit ratings like many other investors who, frustrated with low yields, are taking risks to make up for this. We're looking for what we call rising stars, those companies with low credit ratings but on the rise because of improvements in the credit quality of the company overall. We hold bonds to provide reduced volatility and stability in our strategies, not to act like stocks. Short term, there are still reasons to be cautious. The vaccine rollout isn't going as fast as some would like due to the supply chain, and there are new strains of the virus that could lead to another slowdown or lockdown. We don't believe this is likely, but it is something to keep an eye on. We continue to evaluate equity exposure across our strategies and review whether or not it would be appropriate to add more to our flexible active managers or keep the tight, strict guidelines that we have in place.
So in summary, we are not favoring stocks as much at this time as maybe we were last year, but we'll likely adjust that stance once we have more clarity with some of the policies with the new administration. And as a recap, we're going to barbell some of the growth and value stocks in our models and have some rotation from our US heavy portfolios, move a little bit of that back to developed markets. And with interest rates as low as they are, it could be time to start looking at us shortening the duration and diversifying our credit exposure with the fixed income part of our portfolio. So as an investor, you either need to be comfortable owning a little bit more stocks than maybe you're used to, or accept a little less return while rates are so low. And this is why it's so important, and we always preach keeping more cash in those emergency funds. Bucket one. I'll say this, companies are in the healthiest balance sheet position that they've been in decades, and even households have the highest income and highest amount of cash with the lowest debt burden relative to their income in history. And this is a large reason to potentially be bullish this year, while also, yes, being mindful of government intervention and policies. This is exactly what we sit around, me, Miles, and Carson, in the office and talk about every day, and it must be why everybody wants to hang out with us on a Friday night. So if you want to be added to our market update emails, drop me an email and I'm happy to make that happen. And as I always say, do yourself a favor, turn off the TV, spend time with those you love, doing the things that you love, and I'll talk to you next time.